The topic which we are going to discuss today is about where the money disappears when a recession happens.
The global economy may be heading toward a dangerous tipping point, and this time, the warning is coming from someone who has been right before. Veteran economist Gary Shilling, known for predicting the 2008 financial crisis well in advance, is now warning that the United States could be staring at a recession and a stock market crash. Shilling believes U.S. markets are currently overvalued and not fully pricing in these risks. He suggests that if a recession does hit, the S&P 500 could fall by as much as 20 to 30%.
Recession is nothing but 2 consecutive quarters of negative GDP. GDP keeps falling quarter on quarter. But then on a broad level, recession is the economy is falling. There is no productivity in the country. The gross domestic product GDP of the country is falling every quarter. So it can be 4 quarter, 5 quarter. So these days 2 quarter is normal. These days economies are, if you see, technically in recession zone, but then GDP falling for some number of quarters is considered as a practical recession. But then in such a case, especially when we are talking about US having chances of 25 to 50% chances of going into a recession as per great economists and bankers. So it is relevant to discuss about where the money goes, and if recession is happening, economy is going down, then somebody will be making some money, right? Because the money is always there and then it changes hand from one person to another person. So who are those persons, or is the money really changing, or was the money there, and what is happening while a recession to the so-called large chunk of money which was there earlier. So let's deep dive into this.
Before the war with Iran, the U.S. economy was already in a fragile state. As Mark Zandi, chief economist for Moody's Analytics, points out, the war could make it worse. My angst around the possibility of a recession continues to rise. Goldman Sachs raised its probability of a recession in the next 12 months from 25% to 30%. Moody's Analytics puts those odds at just below 50%. Key business leaders are warning that the Iran war is going to likely exacerbate all of this the longer it drags out.
Before getting into this, you should know about 3 important things in this: money, value, and price. So if you have a clear understanding of these 3 things, then not only about this topic, you will have a clear understanding of how the market works and where the money disappears. So all these things, money, value, and price, interact with each other. They work together, but 3 of them are different. Let me explain. So money, as you know, is an unit used to understand what something is worth, and value is something what we believe, what we perceive is what something is worth. But this belief can always disappear. Say for an example, there is a stock. So there is a stock which is having original net worth, the book value of 100 rupees per share. But then it is having a price to earnings ratio or price to book ratio of 10. So we are paying 10 times the actual net worth of that company to buy that particular one share. So you are believing, you are perceiving that this stock is 10 times worth its original value. So actual money was 100 rupees, then the perceived value, the value was 100 into 10, which is 1000 rupees. So you are paying 1000 rupees for a 100 rupee original worth item. So money, value, and this value can always fall. So I think that going forward, the company is entering AI or some data storage theme and semiconductor boom. So, or maybe some solar initiatives. So going forward, they are going to make large earnings and their book value is going to go beyond 10-20 times, and then the price to book ratio, the price I bought and the book value then it is having after say 5-6 years is going to be much higher, and my price which I bought is would be much lesser considering the earnings it is going to give going forward. So that's an expectation and a belief. Then the company chairman comes and tells that we are bearish, we are not going to invest in any of this, we are going to stick to our own basic manufacturing thing or something like that. Then the entire belief is gone and the price falls. Maybe it goes beyond the book value, so it may become 90 rupees. So it is 90% or 10% lesser to its book value. So the price falls from 1000 rupees to say 90 rupees. This happens. So this is how the market works. So you know money, you know value and price. Price is something which is an agreement between a seller and a buyer. So they come to an agreement that this is worth 1000 rupees, but then how much will you give me? Say I will give it in 800 rupees. So there is, if in context of stock market, if I tell there are a lot of buyers and sellers every day, so I will put my stop loss or I will put my value for buying that 1000 rupees shares at 800 rupees. So there are a lot of buyers for 800 rupees, and if the stock is bearish, the people sell and the price falls to 800 rupees and I will get that 1000 rupees share at 800 rupees. So that's an agreement between a buyer and a seller. So this is all about the price. So now you know about money, value and price. Again stating an example, Tanla platforms. Way back in 2022, it was trading at around 2100 levels. Now as I speak, it has fallen to some 400 levels. So from 2100 to 400 levels, what a fall. So this fall happens once there is a disconnect between the belief of that stock. But then we value investors, not a stock recommendation, but when we value investors find value in such stocks, we invest at lower valuations, and as it goes back to its all-time high of 2100, we make multi-bagger returns in such stocks. So that is how we play between money, value, price and become an opportunist and make money. Similar things happen for crypto, real estate and other assets as well. Crypto is not an asset, disclaimer, but then I am telling. So such things based on perceived value, the value of that asset goes so high, and once the perception loses and the belief gets lost, so the value and hence the price of that particular assets comes down. So value can never be printed on the screen. It is just a perceived thing in our mind, in our brain, and which agrees between a seller and a buyer. A figure which agrees between the seller and the buyer. So when the belief disappears, the value disappears, the stock falls. Well, in that case, an asset, whatever it may be, a real estate also, if there is a dumping yard coming in near to the house or into the near that apartment or something, then the complete value, even though the place is very near to metro, if a dump yard comes, then the entire value, the perceived value of that stock of that real estate goes down and that asset falls. So that's how it works. So the money was never there. It was a perception that it is a good asset, and a 10 times price was quoted and bought on that price, and then that 10 times vanishes as soon as the reality kicks in. If you see, in an economy, in a healthy economy in fact, the money moves so fast. It changes hands and then it moves so fast, which is an healthy economy. So this is something called the velocity of the money. So velocity of money is nothing but how many times a rupee gets used to buy things. So normally in a healthy economy, the velocity of the money is around 5 to 6 times. But then if it falls to a recession or in a poor, weak economy, it is around 1.5 times. So that's the difference between an healthy or a falling economy. In a recession, the money becomes still. There is no change of hands or there is no velocity of money. So now going back to our 3 things, money, value and price. So as the value drops, you sell the stock. So even Tanla case, you have bought the stock at 2100 rupees and now you are selling at 400 rupees. So you have carried that stock for me, like value investors like me. So you have paid that cost, 2100 rupee you have paid per stock. Then after 2-3 years, you are giving to me at 400 rupees, which is a cheap buy. So I buy that, I as a value investor buy the stock at lower valuations, and then I analyze the business and then I understand that this is a value business, it's a good business, and then only I buy. Then after that, I wait for the stock to grow back to its earlier levels. So that's how we good investors or sensible investors make money. So who is losing money? That 2100 rupee guy who had bought that stock at 2100 rupees, he loses, and he loses from 2100 to 400 rupees. How much fall it is? Large fall. So that hit he takes, he loses money, and I make money as I have bought the stock at very cheap valuations. Because people doesn't become greedy when market is fearful. They go the opposite side. If the market is going low, they keep selling, and if the market goes high, they keep buying in the name of FOMO, fear of missing out. The market is going high, I will miss that rally, so I will buy at higher levels, and then the market falls, and then you will fear that you will lose all the money, and at lower levels you sell. So who is making money in that? The one who is buying low and selling high is making money, and who is losing? You, who is getting emotional and selling and buying at wrong times. So as Warren Buffett always used to say, stock market is a place where impatient investors transfer money to patient investors, long-term investors, patient investors, resilient, integrity wala investors. So they know the market cycles. So talking about market cycles, it's a must read that there are a few number of books by Ray Dalio. You should read that. Currently I am reading one book which is this one, the How Countries Go Broke, the Big Cycle. So it's a very interesting book, and also there are some other books by Ray Dalio which I will be introducing in the channel. So this is not a promotion of Mr. Ray Dalio or something, but then I found this book really interesting. And even though there is a video by Ray Dalio how the economy works. So this is another thing which you should see. But then these books, the original edition of the books you should buy. Yes, you may have to spend some 1000, 2000, 3000 rupees in this, but then if you buy the original books, you will have that feel, you will have that reading habit and that eagerness to learn, not the copy which you will get in 100 rupees, but then you will not feel the admiration for reading that book because of the cheap quality of that paper and the looks of that book. So getting back to our topic, so once market slips to a recession, the perceived value about that stock or that assets falls. So they will understand that the market is falling, the economy is falling. So there is what I had thought that after 3 years the stock is going there because there are a lot of themes which the stock was associated with. This is all going to fall because economy itself is not functioning well. So that perceived value goes. So that earnings multiples comes down. The price to book, the price to earnings, and all those values which are related to the price of that stock goes down. So that value was never there. It was just a perceived value. So in a recession, that extra value which was perceived goes down. The price goes down. So the smart investors buys those stocks at lower valuation as people, the fearful people sell and become greedy and buys those stocks at lower valuations so that we make money once it goes up. Rich and smart investors holds cash 15 to 20% of their portfolio in cash in such situations wherein you anticipate economic downturns, especially you know that if the US sneezes, the whole world gets cold. So the US is in a brink of going to recession as they are having a 39 trillion US dollar debt. They are losing their US dollar dominance. They are losing wars. They are losing on their strategies. They are having internal conflicts, political conflicts. So all these things, if it leads to the downturn of US dollar, or well in that case US, then the entire stock market will be disturbed and we will get, if not that high downturn, we'll still get 15 to 20% correction. So this can be used as an opportunity to invest, and this is very normal. It works in cycles. The market works in cycles. The entire life works in cycles. You will have a upside cycle also and a downside cycle also. You will have high levels of promotion and you will reach a peak position in your organization, and there will be drawdowns also. The market falls, the order booking goes down, so you will see your downturn also. Then again you rise up from that earlier learnings. So this is how life works, and similarly the stock market also works like that. There will be downtrend and uptrend, and also as I tell, the market always goes in a sinusoidal up and down trend, but then end of the day it's overall a uptrend only, because market always is bound to go up. So in this Ray Dalio's book also you can see this. See, this is the, if you see there is a downtrend, then it goes up, but end of the day the sinusoidal waves goes all the way up. Then there is correction and again it will go up. So you cannot time the market, it is true, but then Warren Buffett and people like that, they tell that don't time the market, but still they are sitting on cash. So you should take your own takeaways from this, that these are indications, somebody is telling that it's time that you have to, if not time the market, be cautious, remain in some cash, wait for the opportunity. You may lose the opportunity or the opportunity may not come also, but then you should take that risk of holding cash and investing once you get an opportunity. There is a concept called capital gravity zone. So in a recession, the final stop the money takes is at this capital gravity zone. Means all those fearful investors, retail, especially the retail investors, keep selling, and at cheaper valuations this market reaches the capital gravity zone, wherein it is available at a cheap valuation, and the huge investors who are having large cash piles like Berkshire Hathaway or even Warren Buffett comes and invests at that cheaper location. So capital is there, and at that gravity the entire capital gets into that zone and invests at a lower valuation, and then wait for long patiently for the market to regain, the earnings to come back, the book value to multiply and give a multi-bagger return. The opposite of this is capital flight. So capital flight means the capital will go away. So this is where retail investors fearfully sell as the market falls and the money reaches the capital gravity zone, wherein the smart investors enters the stocks. So now you know that in a recession, where the money goes, the money is lost by the fearful retailers, and the money afterwards is made by these value investors or smart investors, wherein they buy the stocks with great conviction, as they have been waiting for a very long time with large cash piles, and then invest with conviction and hold for long, and then take part in the multi-bagger journey of that stock. So now I think the concept is clear. Any doubts or confusion, comment below in the comment box. See you next video. Till then, happy investing.